Hi there, I'm Edward Kalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. In this video, I'm kicking off a 5-part series explaining the 5 key factors I use when analyzing companies. These are the pillars of my investing strategy. And today, we're starting with key factor 1, returns on capital. When you invest money into a company, you want to know how efficiently can this company turn my capital into profits. That's what returns on capital measure. Legendary investors have highlighted this for decades. Peter Lynch often said the best businesses are those that can reinvest at high returns for many years. Terry Smith has called return on capital the single best indicator of quality because it shows how well management compounds shareholder money. Think of it like planting seeds. If you plant $100 worth of seeds and get $5 of fruit every year, that's a 5% return. But if the same $100 gives you $20 of fruit every year, that's a 20% return. Over time, that difference creates massive wealth. There are 2 main ratios I look at. The first one is return on invested capital, which is calculated using the following formula. Return on invested capital is net operating profit after tax divided by debt plus equity minus cash. This measures how well a company turns all capital invested, both debt and equity, into operating profit. It uses net operating profit after tax because we want to isolate how the business itself performs before any financing decisions. Put simply, NOPAT is operating profit after tax, the profit the business would earn if it had no debt. A high return on invested capital tells us the company is creating value above its cost of capital. The second ratio is return on equity. Return on equity is calculated by dividing net income with shareholders' equity. This shows how effectively the company uses shareholder equity to generate profits. It uses net income because we want to capture what's left after interest and taxes, the true return delivered to shareholders. The way I remember it, return on invested capital tells you how good the business is, while return on equity tells you how good it is for shareholders specifically. Take Hermès as an example, a French luxury leader whose brand strength allows it to earn extraordinary returns. Hermès reports a return on invested capital of around 44.9% and a return on equity close to 28.3%. That's what high returns look like in action. It means Hermès is very efficient at turning both debt and equity into real profits, and that gives it a strong foundation for compounding shareholder value. By contrast, industries like airlines often struggle with single-digit returns. They pour billions into planes and barely cover their cost of capital. That's why so many airlines have gone bankrupt over time, while companies like Hermès thrive. This is exactly why I always start my analysis here. Returns on capital tell me if the economics of the business are attractive, before I even look at growth or valuation. Now, pulling these numbers together across dozens of companies can be time-consuming. That's why I use Fiscal, my go-to investment research platform, to quickly analyze metrics like return on invested capital and return on equity. If you want to level up your own stock research, check out Fiscal using my affiliate link below and you'll get 15% off at no extra cost to you. At EKH Capital, I prioritize companies with consistently high returns on capital. Why? Because over the long term, a business that earns 15 to 20% on its capital will compound wealth far faster than one earning 5%. And as Charlie Munger likes to remind us, over the long term, it's hard for a stock to earn a much better return than a business which underlies it. That's why returns on capital is always key factor 1 in my analysis. It sets the foundation for everything else. Returns on capital matter because they reveal a company's ability to reinvest profits at attractive rates, protect itself with a moat, and compound shareholder value over decades. If you want to invest like a growth-focused, long-term investor, always start by asking, how efficiently does this business use capital? That's key factor 1 in my investing framework. Next time, we'll move to key factor 2, growth, to find out how to spot companies with long-term growth potential. If you found this helpful, please hit like and subscribe, and let me know in the comments, do you think returns on capital are more important than growth when picking stocks? Thanks for watching, and I'll see you in the next one.